Hello and welcome to another episode of Monday Markets. As always, we are brought to you by Woo. Links available in the description below. Let's take a look at the market from a technical perspective and then from a futures and positioning perspective. So from a technical perspective, if we work through our main timeframes, there's not a lot going on the monthly. So as you'll recall, the key levels are the monthly range high at 58k, the range low at 35 to 37k, and in the mid-range at 47k-ish, 44 to 47 if you wish to add this entire cluster structure. Now, as we discussed on Casual Friday, it was a really good episode. I mean, they all are, but this one was particularly fun. We talked a lot about the utility of the monthly time frame, and in my view, and Don generally seems to agree, the monthly time frame is best used for buying large, scary-looking dips into or below monthly support. That's really where this time frame tends to stand out. That's not to say that it's bad for other trading sort of systems or signals. So monthly breakouts, monthly levels, all of those work. I think the criticism there is that the weekly time frame usually has significant overlap with the monthly, and you don't have to wait a whole month to generate a signal, a breakout, a trade, some sort of trade management signal. All of that kind of stuff just happens much more quickly on the weekly time frame, and you get more signals. Whereas on the monthly, for buying scary looking dips into support, usually these come on the back of a very sort of scary looking market breaking move, and those moves tend to take a while to sort of permeate and percolate, and other verbs starting with P. So you can get away with using the monthly time frame for those specific high time frame scary looking dip buy setups because they tend to resolve a bit more slowly. However, if you're dealing with setups that aren't resolving slowly, but rather resolve quickly, such as reclaims and breakout signals and all that type of stuff, I think on average you'd be better served on the weekly and the daily time frame. And again, there's a lot of overlap typically between monthly levels and weekly and daily, so we're not disregarding the monthly in doing so. However, for sort of as far as specific use cases go, I think the monthly is best for buying scary looking dips, and everything else can be at least catered to in a slightly more timely fashion by the other timeframes. The monthly view at the moment, I mean, there are 17 days left on this monthly close. If it clears the upper boundary of 47k, that's a monthly mid-range breakout signal. If we view this thing as the for what it is, this large consolidation before our bear market breakdown, if we have a monthly close above 47k, at that point we will have both reclaimed the bottom of the range and then also reclaimed the range midpoint. And at that stage, the range high is your next sort of logical target from a monthly perspective. The obvious sort of logical corollary of that is that if this monthly ends up rejecting, so spike previous month's high, for example, and close below 43k, that would be a rejection signal on the monthly. But again, you'd want the weekly and daily to complement that, or look for setups on those timeframes, because again, the monthly, it's not its strongest in providing rejection signals. I think it's those dip buys into support and failed breakouts, if I had to add another use case where the monthly does best. If you, for example, took this monthly close particularly seriously, you'd be in a tough position at the moment if you just shorted the close, let's say at 42k, hey, look, we rejected from monthly resistance and we're knocking on the door at 50 now. So I think that's a really good example of the relative strengths and weaknesses of the monthly time frame. Not to spend too long here, monthly close would be a breakout signal. It's not the best time frame for that signal. Monthly close below 44k would be a failed breakout signal. Again, not the best time frame for that signal in particular. That of course raises the question, what would be a good example of a monthly dip type of setup, since you've talked about it so much? I think there are two, and these two that we've discussed on Casual Friday at length. One would be reaching into or towards the range high, 58, 60, 62k, whatever, and then offering a larger correction anywhere into the previous mid-range. That would give you your 20 to 30 odd % correction, depending on how high it comes from. So that would be setup number one. The other one would be a rejection from this midpoint, so sort of no close above or a close above that then fails, and a dip towards monthly support at 35k or the low 30s. So really, the monthly time frame, those dip buy setups, you're usually looking for a magnitude of 25, 30%, 20, 40%, something of that nature. Again, there are no laws of nature here. These are just rough estimations from previous large, scary looking high time frame corrections, or at least historic ones. But yeah, that would either have to come from the range high to the range midpoint, or from the range midpoint to the range low, or maybe even we just mega breakout and then nuke 20-30% from whatever high at 80k, 70k, whatever new high target, back to the highs. In any case, if it's not 20, 30, 40% on the monthly, then it probably doesn't fully qualify as that specific dip buy setup. So that's the monthly, again, contextually kind of in an area of resistance, but I think the higher time frames, sort of the slightly lower higher time frames, will do a better job of that. There isn't a lot of signal on the monthly for the time being. We were cautious on Casual Friday and sort of taking this close too seriously, and that has, I think, kept me at least out of hot water, and Don on his trading vacation can do no wrong either. So I think the weekly time frame is the most interesting one, and it was very much the focus of the last episode of Monday Markets, where essentially the argument was, look, we have been in a very tight low volatility consolidation for the last 8 weeks. We've faked out both sides of the range already, tried to wick, didn't go anywhere, closed within, tried to wick here, didn't go anywhere, close within. At that point, when you have a very tight consolidation and both sides have already experienced failed breaks, the next one is probably the real one, so to speak. And I think that there's been some good evidence for that. I mean, obviously, if you wait for the weekly close, then you're taking more quote-unquote confirmation or certainty for a worse price. So the weekly closed higher, and we've sort of pushed higher since then. I think Don made a really good job of arguing for the faster moving daily version of that, something we also covered on Monday Markets, which is the 44K level, which is essentially the daily view of the same weekly and monthly range, which is to say that we already had the failure at the highs, we had the failure at the lows, so whichever way this breaks first is probably going to be the move worth catching. And that gave you a tentative but still valid close on the 7th of February. 8th of February was becoming increasingly clear, and it's sort of marched higher since then. The only other point that I will add on the daily, so just to summarize quickly, the weekly, as long as this breakout sticks, from a technical perspective, there's nothing bearish about it. It looks good. You essentially have, if you look at the anatomy of this thing, you have 25K breakout, followed by a long consolidation. Then you have the 30K breakout, and since then it's just kind of been relentless, right? We had this diagonal march up, another consolidation, and another breakout. There's nothing really bearish on the weekly time frame yet. I mean, this is being charitable looking at it from 24K. You could start making similar arguments at lower prices, but essentially the weekly time frame has been breakout, consolidation, breakout, continuation, another consolidation, breakout. I mean, weekly market structure has been very, very resilient. And until that changes or one of these breakouts fail or something else happens, you're not going to get particularly bearish signals on the weekly if you're viewing it from this kind of larger trend following perspective. As mentioned on the previous episode of Monday Markets, if you are looking for some sort of weekly context, anything that really starts to come back into the range at this point would be suspicious. So anything close to 44K, if this impulse candle starts to bleed out, that would be the first sign of danger. And then more tentatively, the next somewhat relevant level that I've got is at 51.8K. I'm not quite sure yet how much weight to put on this, if any, but I'd rather have something on the weekly than nothing to at least give me a foundation for shorter term trading. And, absent the highs, I think 51.8K is something rather than nothing, which is a phrase I employ with increasing frequency on this show. The only other note, so yeah, that's the main weekly stuff. As far as the daily goes, there's one thing I want to point out, which is that while it's true to posit that the 44K breakout is the sort of real range high that we've pushed away from, at this point, bleeding all the way back down and giving back this momentum would be a bad sign. I think when the market really puts in these large moves, you have to look for a way to move up your invalidation so that if you're in shorter, even medium-term positions, you're not super far away from your invalidation. If you are, that means you risk round-tripping a large part of your P&L. So if the market gives you a newer invalidation or a new price swing or some sort of new structure to use as an anchor closer to price, then you can be slightly more proactive in your trade management. I think on this occasion, it actually makes sense to look at the high at 47K as a decent nearby / closest invalidation. Not only is that the daily high that we set, but if you look at the 4-hour, it's actually structurally a pretty decent level, right? So we had this high here initially, and then the market used it as a bit of a base before the recent breakout, consolidation breakout. You could extend this area, if you will, and sort of look at it from a point of view of hold on, where is this? Yes, you could view this from a sort of updated validation point of view that yes, it's a weekly breakout and all the time frames look good, as long as it doesn't get back below wherever this is, 46.9, 47.4, as long as it doesn't start to look like a failed breakout and sort of bleed back below, that is fine. So rather than relying on the weekly and saying that as long as it doesn't get back below 43.8, we're fine. I think that's just quite far away. You know, even if you're well positioned for this impulse, you'd risk giving back all of those gains. Whereas if we look on the daily, I think we can carve out a slightly better invalidation, not at 43.8, but rather around 47k as the more recent breakout shelf support resistance flip, whatever type of thing. So I think that's what makes sense to me at the moment. And again, above it, the only thing that's of some note is that 51.8, 52k level, which I don't think is super important, but I'd rather have, especially if I'm going to be short-term trading, I'd rather have something rather than nothing that I can anchor to a higher time frame. I think 51.8k is a decent candidate. So somehow, to try to summarize all of that, the technicals look good because we've just broken out from an 8-week consolidation. If you want to be really conservative, then as long as the breakout itself isn't invalidated, then anything that doesn't trade back below 42.2 is still a valid weekly breakout. However, if you're into more active trade management, simply the gap between where the market is right now at around 50k and the weekly breakout invalidation at 42.1, 42.2k, that's 15% away. That's very far. So that, of course, raises another question. Can we find a closer invalidation or an earlier warning system for this weekly breakout if it doesn't look good or starts to turn sour? And I think a semi-acceptable answer is 47k. Okay, and so instead of having to think, okay, well, if it goes down 15% or whatever, I'll be invalidated, we have something, 4-5% away that can perhaps trigger some early alarms. I think that's a pretty decent compromise. So that's what makes sense from a technical view. I'm not sure whether there's any value to look at even lower timeframes. We've essentially just had a pretty steady move since the larger, higher timeframe breakout. And, given this is a weekly show, I think an updated invalidation 4% away at 47k-ish is pretty reasonable, to be honest. Let's look at ETH quickly, and then I want to look at some futures data. ETH BTC doing well today, oddly enough. Slightly counterintuitive. Typically on BTC strong days, ETH has lagged. A bit different. Again, is this a precursor for a trend reversal? I don't know. I've been hearing that for a very long time. A lot of these single candles or even consecutive days have generally bled out, and it's been very hard to sustain strength in the relative pair. So I'm not exactly holding my breath, although the weekly time frame is probably the most interesting one. Again, I'm just going to borrow from Casual Friday here because it also lines up with my technical view, which is to say that there's a really good level at 2500 as an inflection point, sort of previous range low, gave us some trouble for a couple of weeks, and now the market's poking its head back above it in the early part of this week. So I think if you get a week, I think just like BTC, the argument was just take the weekly signal at face value. I think that similarly applies to ETH with the proviso that ETH BTC has been weak. So if you preferentially trade BTC, no one will persecute you for that. But that said, if there's a weekly close above 2500, even if you're late to that, I think there's enough space until we start to push into the next trouble areas, at the earliest at 3200, I think. So that's, even if the weekly close is significantly higher, there's still a decent amount of space to capture until the next conservative resistance. That said, if we have to pay for our sins by pumping ETH and this weekly close ends up failing and falling below 2500, then I think all optimistic views for the next week or 3 wouldn't be supported. So just like we were waiting for the weekly close on BTC, and you could take advantage of that on lower timeframes to catch the weekly breakout, I think the same applies for ETH. You could either wait for the weekly if you want to be conservative, you could wait for the daily time frame if you want to be slightly more aggressive, but in either case, 2500 is the inflection point there. Now, from a positioning point of view, and again, altcoins are all just getting lifted, no huge surprise there. Ordinals, or Audi is doing well, rather. Say, Solana, slightly slow. STX, sort of proxy bet for BTC nowadays. The hat is back on the dog, whatever that means. And yeah, a bit of a mixed bag. We can take a look at some more altcoins in detail, but I want to talk about positioning first. Now, this is the interesting one, right? So I've got BTC open here, and from a positioning and futures perspective, this is really quite aggressive. Now, the price move itself is also aggressive, so it's not like we have a huge ramp in open interest and premiums out of nowhere, but it's always a question of proportion, right? So how much leverage essentially is being deployed and what kind of corresponding price move do we get. Now, on this occasion, if we do some very simple analysis and just kind of look at this pump on its own, so from the lows to the high, if we look at the change in open interest, it's been a roughly 7% change to where we are now in open interest, and a peak of about 8-9%. And most of that has been obviously an increase in open interest. Net positioning expanding. It doesn't mean it's all long, doesn't mean it's all shorts. There's always a long for every short and vice versa. That's how perps work. But we can get a sense of who's being aggressive as net positioning is being expanded by looking at two things. One is essentially funding rate, so the difference between the index price, so a basket of spot instruments, and the perp price. And we can see a corresponding pretty significant spike in premiums as open interest ramped up as well. Now, sometimes this can be okay, and it's not necessarily a sign of froth, because liquidations will push the perp materially higher than the index, because, you know, spot doesn't really have liquidations unless you're on a spot margin, whereas perps, people using leverage, especially leverage shorts getting blown out, they're not getting filled at particularly good prices. The market will just skip a few price points, and leverage essentially exacerbates the move that you get anyway. So sometimes what you'll see is initial spike in perp funding, and you'll think, oh my god, it's so frothy, the perp is trading so far above the index, but that's a function of liquidations. And as the market sort of stabilizes, the premium kind of comes down on its own to more reasonable levels, and suddenly this doesn't look so scary. However, what you don't want to see, while this is a sort of meaningful increase, what you don't want to see is, for example, the market starting to retrace and for the premium to continue to increase. Or to be honest, for the market to just consolidate and do nothing, and the difference between this index price and the perp price to essentially stay elevated, because that essentially means that there's a lot of expectation from these participants, or at least a decent portion of them. You can view these as sort of expectations to make money on the long side. And the funding is essentially the cost of holding those long positions open. So if you have a lot of new participants entering around these prices, right, and it's expensive for them to hold those long positions open, but then the market isn't rewarding them and isn't doing shit, it's either moving sideways or moving down, then those participants are more likely to puke, because from their perspective, they've entered at a price that's not so great, and not only do they have a price expectation, but there's essentially a cost to expressing their view. So the longer the market does nothing, while the cost of being long is not insignificant, that essentially ends up bleeding into the available margin that you have, and it's just expensive to be long a market that's not moving if the cost of being long is high. That's probably the best way I can summarize it. So you can sort of synthesize these things together and view sort of open interest to get an idea of what price a lot of this participation is centered around, and then you can look at funding to see, okay, even if these guys don't have the best entry, if the market goes up, they'll be fine anyway, so it doesn't matter. Problems emerge when those participants with meh entry prices then have to pay quite a lot every funding period to keep those positions open that aren't making the money in the first place. And so those types of participants are both price sensitive because their entry isn't the best, but they're also time sensitive, because every funding rate, if the funding rate is high and the perp is trading significantly above the index price, that shit is expensive and it cumulatively adds up. So they have an expectation of price going up, but they also have an expectation of time and that price going up quickly, not in a week or 2 weeks or a month or a year or whatever else. Okay, so they're doubly sensitive, so to speak. The other supporting piece of evidence for this can be seen in the 3 quarterly annualized basis. So we've talked about this before, what it means. These are the quarterly futures. You take the difference between basically the basis, the difference between the spot/index price and the quarterly futures price, and extrapolate it over a year. These have seen a significant spike. So Deribit always, for some reason, gets pushed out of line. I'm sure someone really intelligent can has a thesis for that, but just in general, even if we take take an average, this is a significant spike as well in the quarterlies. So the basis on Binance is up to 13%, and that's, you know, it was marching up this whole time from a low of about 8-9%, which is okay. It's still slightly on the higher side, but again, it's not about the basis being either objectively high or objectively low or whatever else. It's always a question of what is the premium relative to price and price action. So for example, you can have bull markets where this shit just stays at 15, 20%, and it has gone significantly higher in previous bull markets, but it ends up having no impact because the price also keeps going higher and higher, right? So you can say, oh my God, you're paying so much in funding to be long. It's like, yeah, motherfucker, this shit's moving up 5% every day. Like, I'm fine. I will stomach the high funding cost or the cost of being long if my P&L more than pays for it. Again, it's not just a matter of the funding is high or the basis is wide or whatever else. It's always a question of time, right? It's always a question of time. Yes, it's expensive to be long, but if I'm getting paid, it's fine. Or yes, it's expensive to be long and holy shit, the market's not moving, or even worse, the market's moving down. And it's that mismatch between the premium and the corresponding price action that creates problems, okay? So I will say that 13-ish% is slightly elevated. And again, looking at it from an open interest point of view, this is a material increase in open interest relative to the price. It's okay as long as it keeps going. But if this market really starts to slow down and consolidate, or even just like sometimes what I'll do is I'll look at 15-minute to maybe hourly market structure and just kind of mark out the low. And a lot of the time, unless it sweeps and reverses, just does that and just keeps pushing. If there's like an hourly or lower time frame break in market structure on the back of a large open interest ramp and funding is sticky and doesn't kind of correct with time, then that can be decent confluence for a short-term counter-trend move. And the argument there essentially is, look, a bunch of guys piled on around the highs, expecting price to jump straight to 55K or whatever else. They are price sensitive, as we discussed. They are time sensitive, as we discussed, and they're not getting paid for it. And their expensive exposure to the long side isn't paying off. They close their longs, those turn into market sales or liquidations, so on and so forth. Okay, so that's a lot of rambling. I'm trying to sort of interweave education into it. If it's helpful, let me know. If it's not, then you just want my opinion, let me know. So I think on the premium side of things, looking at perp funding rates and quarterly basis, I think it's a bit high. If the market just like basically consolidates and shoots off, it's okay. Those positions and the cost of those positions will get bailed out. I think if the market really starts to slow down here, there's a decent chance we'll unwind a lot of this newer participation, okay? And from a trading point of view, again, this is something you have to monitor. Will the premiums come down post liquidations? How quickly is price going to move? What is going to be the relationship between these two things and price? Sometimes you'll see really scary shit, like price moving lower and then the premium gets even higher, right? That's not a good sign. Other times it'll just kind of neutralize on its own, right? So you have a slight washout in open interest, funding goes more or less back to baseline, and market doesn't break market structure, and you're like, okay, that was enough of a reset to justify a leg higher. So this isn't one of those things where you can just look at it and be able to predict the next N number of moves. It's one of those variables you have to monitor, because just as positioning changes in real time, so too do these metrics, okay? But these are the things I'd keep an eye on: open interest, perp funding, and then quarterlies as well. Yeah, hopefully I've presented that in a somewhat digestible format. If you have any questions about this kind of stuff, leave them in the comments. I will say that on my Medium, I've got a very, very long form article that talks about all of these at length, and they'll do a better job of conveying these pieces of information better than I could hope to, even though I wrote them. So if you want a deeper dive, just go to CryptoCred Medium, and there's some comprehensive whatchamacallit article there. Yeah, I think that's it. I'm going to shut up. This is a very long video. It's somewhat rambly, but if there's one useful thing you picked out of it, then I guess I've somewhat done my job. Leave a like if you enjoy these. Subscribe to the channel. Looks like BTC might beat us to 60K, but it'd be nice if Technical Roundup could get there first. Thank you to Woo for supporting the show. Again, it's really changed a lot as an exchange since Don and I signed on. It's materially different, especially from a diversification of liquidity provision perspective. If you haven't tried it in a while, I've always been on the fence about it. You can check it out via the links in the description if you'd like. Again, don't put all your money on there. It's a crypto exchange at the end of the day. But if you want to click around and see what it's like, then you can do so by supporting the show at the same time. I'm going to shut up. Have a wonderful evening. trletter.com for our newsletter tomorrow, and I'll see you later in the week. Bye-bye.